Let's break down the mutual fund industry a little more, as this is where a good majority of us stay because it's comfortable. And when we think of mutual funds, there are so many different classes to mix your savings in. I'm just going to provide a high-level overview here for context, as the mutual fund industry is highly regulated. Um, Financial advisors spend several hours in class trying to learn about each fund and the manager who manages the money on it. And there's tens of thousands of funds to invest in. And you just have to ask yourself if you think it's possible for a financial advisor to know all about each of these funds intimately and the companies that perform inside of each of the funds. Financial advisors do their best to educate us in different risk categories and are coached to ensure we are diversified to manage the risk versus reward profile in our portfolio. And they do this when you think about back meeting with your financial advisor to determine your risk profile. They probably had you fill out a know your client form to aid in determining risk. And this is a process in place to protect them from liability for when your portfolio doesn't perform as expected. And your risk level is determined based on how you answer those questions, and the financial advisor is regulated in Canada to protect you from taking on too much risk. And Canada requires this Know Your Client assessment by law for financial advisors to complete annually based on your level of comfortability on areas like emerging markets, global exposure, time you want to stay invested, do you want to preserve your capital, etc. They may ask questions like, are you comfortable with your capital increasing over a 10-year period? Can you stomach if it is a negative return for a short period of time? Then the advisor will mix your capital across a blend of asset classes into portions of each sector of risk. You'll never likely get 100% in equity funds, which can typically return the highest returns because the risk is greater to have a negative return, and they could get fired. Just reflect on why you're investing in learning how to manage your own money. It's likely because you may have had a few not so favoring years or lost money. So let's move on to get into talking about the different classes and where they fit in the different levels of risk. We will start with the lowest risk level mutual fund asset classes available. For illustration purposes, I group them into industry average level of returns, starting with the lowest performing returns. Money market funds invest in the purchase and sale of large volumes of very short-term debt products, like government treasury bills or certificates of deposit or short-term loans. Some of the investment products are difficult to buy unless they are purchased with large volumes, and fund managers have access to these types of products and can give the retail investor exposure to these investment products by offering money market mutual funds. Some low-risk debt securities can pay dividends that generally reflect short-term interest rates to help on providing a positive return. On average, these funds are considered the lowest risk mutual funds and can provide an annual return ranging from 2 to 3%. Most money market funds have the name money market in the name of their funds. Usually each institution will offer a money market mutual fund of some kind. And a couple examples you might have heard of might be Fidelity Money Market Fund or Vanguard Federal Money Market Fund. Next, moving up to a higher level of risk, balance funds. They are hybrid funds diversified among 2 or more asset classes and is generally low to medium risk. A common starting point for reference of how a balanced fund is designed would be 60% of the holdings to be in stocks or equities and 40% to be in bonds. However, each balanced fund is unique to itself. And similar to the money market funds, balanced funds sometimes have the word balanced within the name of the fund. A couple examples of balanced funds names would be the American Funds American Balanced Fund, or the JP Morgan Investor Balanced Fund. Also in this range of risk-reward returns are income funds. An income fund's goal is to provide an income from investments, often in the form of interest or dividend-paying investments. An income fund manager would likely load the fund with multiple stock companies that pay dividends regularly and are reputable companies. Some examples would be Vanguard Dividend Growth Fund or Nicholas Equity Income Fund. Bond or debt funds would also be in this risk-reward class. And bond funds are designed as a pooled investment vehicle that invests in bonds or other debt securities. Very similar to a money market fund, however, the money market funds would specialize in very short-term assets that mature in less than 1 year, whereas bond funds may vary up to 10 years to mature for long-term bonds. Here are a couple examples of bond funds: the BNY Mellon Corporate Bond Fund or the Vanguard Global Credit Bond Fund. On average, these funds are considered moderate risk mutual funds and can provide an annual return ranging from 4 to 7%.